Hey, what's up guys, Michael here. Today's video is about mistakes in trading that should be avoided at all costs and the solutions to them as well. So without further ado, let's start from dismissing the stop loss after the conclusion of the transaction. So determining the stop loss size usually affects the selection of the size of the transaction volume, and this determines the scale of the risk taken for a given position expressed in cash. So it happens that the investor concludes a transaction by selecting a lot and setting the stop loss so as not to lose, for example, the agreed 5%. So the game is slowly evolving. Meanwhile, the trader has doubts and believes that stop loss is too close and prefers to move it away to reduce the likelihood of a cut. And indeed, the further the stop loss is, the less chance it will be achieved. So, by performing such a procedure, we will certainly lose more than the 5% agreed at the beginning. So, is that okay? Well, isn't it said that capital and risk management is at least 50% of the success in the market? So, if you have a set stop loss in a given place and selected a volume for it, it means that you did it in accordance with some assumption. So, don't increase the risk in the game. However, if you feel that you have made a mistake in placing it too close, it is a signal to think more carefully about your next move before opening a position. So the next mistake is being driven by emotions. Well, what if the price is about to turn back? Enter here or wait a while? But why wait? I'm entering here, or I hope it will turn back soon. I would like to not lose again. I prefer a small certain profit rather than waiting until I get another stop loss. So beginners sometimes fight with thousands of thoughts. They are tormented by various emotions over which they cannot control. They are afraid that they will lose, they are afraid that they will not earn. And on the other hand, they hope they will not lose and they hope they will earn. They doubt whether they are doing well. And there are a lot of options, all due to money. The will to be right or to be successful at all costs. You can't turn off emotions completely. One can only learn to control and not to give them too much to talk. So, cool calculations and decisive action is what an effective trader needs. If you know what to do, just do it. Don't get emotional. And if you don't know what to do, it's best not to do anything until it changes. Okay, another one is a failure to stick to the rules of money management, which is one of the most important things in trading. Everyone who has dealt with any financial market seriously knows perfectly well that risk control and skillful management can lead to success, even if the transaction itself is average. If you do not have clear money management rules or simply do not stick to them, know that your account balance is at high risk in the long term. Matching the trading volume with a more or less system or exceeding the set level of loss per trade can lead to greater profits than normal. But well, maybe. But as a rule, it leads to quick bankruptcy. So if you do not know how to correctly choose the lot size or calculate the risk, use the FX calculator for this purpose. There are a lot of solutions on the web. I discussed also that in my video about my FX book. It requires a minimum of effort and in the long term, it will have a positive effect on your account balance. So next on the list is not sticking to the trading plan or just poor knowledge of it. Since you are starting to invest, it means that you have a plan of action. An action plan in which you assume transactions under certain market conditions. After all, you need to know when to open a position, when to close it, and whether or not to secure it with a trading stop. A clear one, for you of course, and precise system is the basis on which you rely. It often turns out that after concluding a transaction, the trader starts to think about when to actually get out of it, or when to choose the next one to earn even more. You quickly forget about clear input-output conditions consistent with the system, or worse, it turns out that they were not understood at all and did not take into account many important aspects, for example, volatility drop, the sideways trend, etc. Then, instead of using the system that was supposed to ensure your success in practice, you start to wander in the dark and you hotly create new variances. If you have decided to use it, it means that you have previously checked its effectiveness in some way, for example on historical data on demo account. Then why do you suddenly change its conditions? Think about it before you start changing anything, even if the system is temporarily having a bad time. Okay, another one is trimming profits and holding losses. That's a classic. One of the commandments of trading is cut losses, let profits grow. Probably every novice investor applies this commandment in practice, but in an opposite way. This is because, as a rule, we are guided by hope and fear. Having a profitable transaction, we are afraid that it will soon turn back towards stop loss. On the other hand, when the loss increases all the time, we are guided by hope, thinking that in a moment and for sure the course will turn back, and we will avoid disappointment. Meanwhile, the correct approach should be completely different. But most of all, to do that, you need to suppress the harmful emotions that cause this havoc. When you see that something is not going as you expected, cut this loss or tighten the stop loss and wait. This order is by all means to help you with this difficult decision. Another issue is that to put it in the right place, of course. So, in the case of increasing profit, traders usually itch their finger, which is just waiting for the green light from the brain to be able to click with the mouse on the closing position button. Why rush it? If you are playing with take profit, wait until it is reached. If something disturbing happens in the market, you can protect some profits by moving the stop loss. There are many options, and the worst thing is to wait nervously with the mouse in your hand and to close the position with any profit. Okay, another one is making unnecessary transactions. Going back to the itching of the trader's finger, it also accompanies another situation. When nothing happens in the market, or our proven system suddenly does not generate any signals to enter the market, we start to worry. Maybe something is wrong, maybe the system has stopped working, and yet we are running out of pips. Relax. Forex has never escaped to anyone. Playing hard to play is a hobby, not an investment. The problem is that in the long run, it can be an expensive hobby that generates a very moderate pleasure and even mentally deliberating. So my advice? Turn on the demo account and click there as much as you want. When your finger stops itching, turn on the real account and watch the signals coming from your system. Be patient. Better to lose a trade opportunity than your money. Oh, and I think that can even be a good quote to put on the wall. Okay, last but not least, the lack of discipline. At one time, a documentary entitled $1 Million Traders was broadcasted on the BBC, where people of different age, gender, education and profession were offered to participate in the experiment. They all had one task. They would get access to the stock exchange, an account to invest, and after basic training, they were to start trading. One conclusion was that those who were the most disciplined, including a retired soldier, did the best. This shows how important is discipline and sticking to the assumptions when investing. If you find yourself checking your position irregularly without focusing on signals coming from the trading system, not sticking to the set assumptions or missing important moments in the market, it is a clear sign that you definitely need to work on discipline. So, at the end, what I would recommend to someone who is just starting it, to find someone who has a verified track record of solid profits, consistent profits also, and follow this person. Check some free courses on the internet. There is a lot of materials published for free to watch or read. Don't trust anyone who is offering you astronomous returns if you just invest a couple hundreds. And another thing is to choose the right broker. And of course, I will tell you to choose LiteFinance, it's natural, it's their channel after all. But to be honest, you can do a simple comparison. How is the broker customer support? What are the deposit and withdrawal methods? How they solve all your issues/problems? And are they market maker type of broker or ECN/STP? Meaning if their earnings are tied to the fact that client is losing money and there is a clear conflict of interest, or they earn by being a middleman between you and the liquidity providers. So remember to always choose ECN brokers. Okay, so this is the end of the video. Remember to check LiteFinance on other social media like Instagram and TikTok. You can find me over there as well. And if you like this video, just subscribe for more.